All right. Good morning, everybody. It's now February 2025. It occurred to me this morning that I started doing these webinars for our Altos clients and friends 5 years ago. And at the time, it was the start of the pandemic, and everybody assumed that lockdowns and pandemic and all the things would cause the housing market to crash, like crash. And my assumption at the time was, well, what we should do as a company that analyzes the housing market is help people see what's happening as it's happening. And so we started doing the webinars and we started doing our weekly video series so that we could share what was happening as it was happening. At that time, at the beginning of the pandemic, it turned out that it was only 3 weeks of market downturn before the data started to turn really positive. And we were looking around like super surprised. But suddenly it was April or so, and people were buying houses. And so the point of doing the data here today is that we want to keep that in mind is even when we expect things to be bearish, the data can turn quickly. Even we have expectations about market recoveries, the data can surprise us. And so I try to be humble and let the data tell us where it's telling us. It tends to be a lot more fun to be able to do these things when the market's growing and people are buying houses. Um, the data isn't that bullish right now, and so we will keep that in mind as we're learning what the market is telling us. So we're going to spend the time with the data today and dive into the housing market. There are really four questions that are on my mind right now, and I think worth paying attention to. So home sales have started 2025 at or below last year's already low levels. And the question now is, can home sales turn around this year? Uh, in the last 6 weeks or so, 8 weeks, home prices have gone significantly softer across the country. And so the question is, they're still positive. Home prices are still a little bit higher year over year. And it's very rare in the history of the US economy that home prices are negative for a year. It happened during the bubble burst 20 years ago, but only occasionally in different times since in the last 50 years have home prices been negative in a given year. And it's a question is, do we see that in 2025? Inventory has been growing. How much will it continue to grow this year? And which markets, the shift in the markets is the markets are shifting right now. The ones that were stronger last year are easing down a little bit. Some of the ones that are the most soft, like Texas and Florida, inventory is growing less quickly now in those places. So we're going to dive into some local markets and see where the risks are shifting and what we might expect for the rest of 2025. Before I show the data, I wanted to encourage anybody who isn't already a subscriber to Altos. You can now go to the Altos Research website, altos.com, or altosresearch.com, and get a free report and sign up for a free Altos account to get the data. And I'll show you some of that later on today. And so if you're not already set up in the Altos system, you should do that today so that you can look at your local data and also connect with our team to dive in about how to communicate about the market. So altosresearch.com, enter your zip code, go set up your free account today. If you're not already do that, in there, I encourage you to do so. All right, let's dive into the data. Let's start with home sales today. So what we do at Altos is we're tracking every home for sale in the country every week. We track out all the ones that are pending and the newly pending. And so if we look at all the homes in contract, this is a single family homes. There are 304,000 single family homes in contract right now. So these will will sell closed sale. They're in contract now. Some will close in February, and March. That generally is taking about 30 to 40 days in contract on average. So the 304,000 homes that are in contract now will close in February and March. The notable thing is that there are 3% fewer homes in contract now than last year. So right now there's 304,000. A year ago, there was 314,000 single family homes in contract. As we ended Q4 last year, there were actually about 5% more sales in the fourth quarter. But as of January and February, sales have come in weaker. So there are 3% fewer homes in contract. So what that implies is that these homes are going to close in February and March. It's basically we have visibility on Q1 of home sales for Q1. Now, those won't get reported until like April because the sales won't close until March, and then they'll be reported in April and May. But we really have visibility for this home sales in all of Q1 already, and they're looking like a fraction fewer, 3% fewer sales than last year. Maybe roughly equivalent. There's no sign of sales gains. And the gains from the fourth quarter are really seem to have evaporated. So you can see that sales will kick up through the end of June, and then they decline through the second half of the year. So that's the normal seasonal curve for home sales. We look at the newly pending contracts each week. So that was total contracts pending. Right now, there were 60,000 newly pending home sales this week for single family homes. That is the same as last year at this time. So 2024 and 25, about 60,000 new pendings. So the good news is that each week this year, we've had fewer home sales. And this week we tied last year. So maybe that's a slight bit of good news about the newly pending home sales across the country. These can be affected by weather and, mortgage rates. Obviously, mortgage rates are still around 7%. So you can see that that is giving buyers don't really have any motivation to jump in faster and buy sooner. So there isn't any, we have had this is only the second week this year that we've had at or above the same number of home sales as a year ago. And as long as mortgage rates stay at 7 or higher, we don't see any catalyst for this improving. In the fall, mortgage rates back here in September, that's when they dipped to about 6%. And it wasn't until 6% that we saw some motivation of buyers. And so in September, October, November, we could see slightly elevated improved home sales that carried into the fourth quarter. And as of the fourth quarter, that's when we were forecasting that momentum would continue. Because mortgage rates jumped again, that took the steam out. And so as of the first quarter, we can see the purple line here is coming in pretty much every week below the sales number of last year. So that's pending. That's the newly pending contracts, or 60,000 newly pending single family homes contracts. That'll peak in May and June and then decline for the second half of the year. The takeaway on home sales is that first quarter is basically in the bag, and there are no signals of any real growth in the data. It's probably about 3% or so fewer sales than last year. So if our forecast for home sales growth is going to succeed for this year, if we're going to be right on our home sales growth, then we're going to need to see mortgage rates drop in the next handful of months and drop far enough to move some buyers off the fence and into action to get any pickup over the sales of last year. If that doesn't happen soon, we at Housing Wire will probably have to revise down our forecast for the total number of home sales for 2025. Let's switch to inventory. So I have here a 10-year view of the unsold homes. This is single family homes, unsold homes on the market across the country. There are 638,000 single family homes here at the very right end of the chart is where we are right now. 638,000 single family homes on the market. That's 29% more homes for sale than last year at this time. You can see last year is down here at just under 500,000. So 640,000. This is a significant growth in inventory. We've had 3 years of growing inventory as we've had 3 years of rising mortgage rates. Obviously, as rising mortgage rates have curtailed demand, therefore inventory builds up. The notably back here in 2018, 764,000, 2019, 814,000 single family homes. So we are still a third fewer homes on the market than the pre-pandemic time. In the beginning of 2020, mortgage rates were falling and the market was already heating up pretty dramatically before the pandemic hit. So here's the April pandemic time when lockdown first happened back in 2020, 5 years ago. At that time, mortgage rates fell dramatically. We started buying everything in sight. And so inventory fell dramatically all the way until the first quarter of 22, 3 years ago. And then rates started rising and inventory started rising again. So that's the curve. And what we can expect is that assuming rates stay in the 6s and 7s for the year, that inventory will continue to rise for another year into 2026. There isn't any sign of like a big surge of sellers, and we can look at the new listing volume to come up with that analysis. So new listings, there were 57,000 new listings of single family homes this week. There are, in this chart, each line is a year. The gray lines are the years past. I've got the purple line is 2025. The blue line is the curve for 2024. So what we notice is that there are slightly more listings each week, slightly more unsold listings that add to the market. 24 was a little higher than 23, but we're not yet back to the old normal levels. So like in 2020, there were 74,000 single family homes listed in February. There were very often 80,000, 100,000 back before the pandemic. In the old times, there might be 100,000 single family homes listed for sale in a given week. And right now we're at 56,000. So this is what I call, it's a healthy growth of new listings. Now it's part of it grows because demand is light, and so they're building on the market. But we've been in the post-pandemic era. We've had the big challenge has been too few sellers, and as homeowners have ultra cheap mortgages, they are reluctant to sell. We call it locked in. They're locked into their ultra cheap mortgages. Interestingly, the high rates now is not what creates the lock-in. It's the low rates from back then that creates the lock-in. So even if rates fall again, we won't have a surge of sellers. We will have more buyers. So if rates fall, we expect that we'll have more, will motivate demand faster than supply. So if rates were to fall, for example, into the 5s this year, then we would see inventory tighten and sales improve, but we wouldn't see a lot of seller volume. We see a little bit more seller volume, but rates will spur the demand side faster than the supply side. And you can really see that in the new listings here. So there are plenty of folks who are assuming that because the housing market is cooler, that there's a big surge of listings. There's a big sellers. In fact, this week, the big social media storm was about the Washington, D.C. housing market. And because the they're cutting government jobs everywhere and they're cutting things all over the place, that suddenly the Washington, D.C. housing market is tanking and that there's all kinds of listings. And if you are on social media, you may have seen this like concept get spread around uh, with like a screenshot from a Zillow where it's got a bunch of red dots. So look at all the listings. Um, and I'm going to show you some DC data later on, but the short answer is it ain't tanking. There's not a lot of listings for sale, and you can see nationally the new listings volume is just a little bit of growth, but is not anywhere near where it used to be in terms of the total number of sellers. There's just so many Americans who have such a great deal on their mortgage that they're hanging out, they're staying in place. So that's the new listings volume. The takeaway on the new listings volume is that we have slight growth, which implies we'll continue to have inventory growth, but we don't have any surge, not even back to old normal levels, let alone like high levels uh, of new listings. And we don't even have that we don't have that in places like Texas and Florida. We don't have it in DC. It's just barely, just a little bit of growth in terms of seller volume. I'll show you some of those local markets later on. Now, let's look at the state level. If you've been paying attention to our webinars over the last few months, you'd know that Florida and Texas were really leading the inventory growth year over year. It's now shifted because Florida and Texas really all last year had a lot of inventory growth. Those markets slowed way down. And so Texas now has 30% more homes on the market than a year ago, but the national average is 29%. So Texas is basically average. The states that are leading in inventory growth now are California, Arizona, and up here in Vermont. Um, the the Texas and Florida have plateaued a little bit in terms of their inventory growth. Now, when we look at the maps, the more purple it is, the more inventory growth. The lighter the colors are, the less inventory growth. And you can still see the upper Midwest and the Northeast has less inventory growth than the rest of the country. In fact, you can see Connecticut has almost 6% fewer homes. Here's Indiana, 27%. Down here in Mississippi is 21%. So you can see inventory growth pretty much across the country, but it's really shifted. And so the markets that were softest were Texas and Florida last year, and the inventory growth in those states is in many of those places has plateaued. What's interesting, okay, so California leads in inventory growth now, 45% year over year. But if we look at compared to 2019, now you could see that California still has 30% fewer homes on the market than in 2019. So California still has a lot of room to grow before inventory is even back to normal levels. There are 8 states that have more homes on the market than in 2019. A lot of these states are big construction states. So Florida and Texas, even Idaho and Colorado, these have a lot of construction and a lot of population growth in the last 5 years, 6 years. And so those have more homes for sale. You can see that these 8 states really haven't changed much. Like these are the same 8 states that have had more inventory than 2019. During the year last year, I was assuming that it would get to be like we're getting closer on some of these. Like California, for instance, is getting closer to the 2019 levels, but these are still the same 8 states. We can look at, Connecticut has 80% fewer homes on the market now than in 2019. Illinois has 70% fewer homes on the market than 2019. And, Virginia, we were talking about, is the DC market crashing? Well, Virginia has 46% fewer homes. Maryland has 60% fewer homes on the market. Indiana, 28%. So Um, so gradually we're getting more closer to the old normal levels. By the end of the year, we'll probably have a few more states flip positive. And we'll have places like California and Arizona to be closer to their 2019 levels. We use 2019 as a metric because it was pre-pandemic. It was normal, sort of normal at that time, but it's not magic. It was just like the last year before everything went haywire. So when we look at the forecast, we put all that together. We look at the forecast for inventory for 2025. We're expecting inventory to grow another 18% in 2025. We've revised that forecast up a little bit as mortgage rates have stayed higher this year and inventory has grown a little bit quicker. So here's where we are. There's 638,000 single family homes on the market. The light purple line here is 24 was last year. A couple of things you can notice here. In the old times, inventory would peak in late summer. In fact, 2019, it was June, but July, August was very common. In the last 5 years, inventory has peaked in October, November, much later in the year. The seasonality is kind of evaporating a little bit. So in 2019, 2023, inventory didn't peak until late November. Last year, it was October. This year, we're forecasting October. So by the end of the year, we should be very close to the old normal levels. We're basically back to old normal. And this assumes that rates stay in the sixes and sevens during the year, that inventory will continue to build a little bit. If some surprise happens and mortgage rates fall, as I mentioned, that would spur demand faster than supply. And so then we would see this inventory number start to tick down and we'll see our forecast start to compress again for the end of the year. As of right now, we're expecting about 766,000 single family homes to be on the market at the end of the year. That'd be up 18% over where we started the year. It would be just fractionally below the 2019 level. In 2019, mortgage rates were falling late in the year, so the market was already heating up, and so inventory was starting to decline pretty rapidly already. So that'll get us pretty close to the old normal levels. So that's what we're looking at right now. And in the last few weeks, we've inched up, revised up the forecast about from like 15, 16, 17 to 18%. Okay. One of the reasons that inventory is building is that homes are staying on the market about 12% longer than a year ago. They're currently 81 and a half days on average for single family listings across the country. You can see last year, I've highlighted last year, it was 74 days. 2 years ago, back here in February, 72 or 72 days. So a little bit of growth. And then, so significant growth, 12% longer. And in the old days, 90, 100 days was not uncommon. So I anticipate that there is room to grow for days on market this year. Now we're at the seasonal peak right now because we have a lot of new listings coming on in the spring. And so that'll bring the days on market, the average days on market down. You have the most transactions that happen. Then in the second half of the year, days starts climbing again for the properties that have been sitting on the market throughout the year. Let's switch to prices. So as I mentioned at the beginning, one of the questions on my mind is, could home prices turn negative this year? As of right now, home prices are up 2% versus last year at this time. The median price of the newly pending contracts this week was $386,000. That's right here in the purple. And last year at this time was $378,000. So just a little bit higher. So this is the price, that point that people are buying across the country right now. And we haven't seen prices decline, but you can use this chart to see when that did happen, when it actually has happened in the past. So in 2022, We started 2022 with strong demand because people were buying everything in sight. We knew that the boom was ending and that mortgage rates were rising. And then at the end of June, if you rates had risen over 5%, and if you didn't have your deal done, people stopped buying at that point. They stopped really quickly and they shifted into bargain mode. So the only things that were buying by then, by July, were those that they were getting a discount on. And so we could see home prices drop from 391 to 370 in the matter of a few weeks in 2022. Then in the end of 22, mortgage rates jumped in September and October, jumped from like 6.5 to 7.5, and buyers reacted again. And so you could see this 375 to 350, a really dramatic drop in home prices. So we don't see that dramatic drop happening now. What we see is that we're staying at 7% for longer. And so we're getting less of the spring climb. And it could be that if home prices peak in here and start declining, we could find ourselves below the 2024 numbers later in the year. The blue line here for 2024, in September, that's when we hit 6% mortgage rates. They dropped down real briefly to 6%. And in 2022 or 24, last year, that actually surprisingly helped keep prices robust. People were buying stuff quickly in the fourth quarter. It kept this, a real contrast of the prices from 24 with 22. And these were spiking mortgage rates, and this was a drop in mortgage rates. And so you could really see how quickly consumers reacted to that. If we get lucky and mortgage rates slide down this year, then transactions will pick up, prices will probably pick up too. As I mentioned, it would spur demand faster than supply. And so then we would probably peak. You could imagine us keeping our slight 2 or 3% home price gains for 2025. That's the newly pending contract. So those are the ones going into contract each week. And that's the price point that people are buying. It's the sales price before the sale happens. If we look at the states, so we look at our map again for the states, you can see that the upper Midwest and the Northeast, the bluer the state here is, the greater the price appreciation year over year. So 9 in Ohio and 10 in New York. You can really see where the price appreciation has been in the upper Midwest and the Northeast. Price appreciation has been much softer in the South. You can see Georgia, as of this week, was at just fractionally below a year ago. Texas was, so these are all basically unchanged from a year ago. Anything within 1 or 2% could bounce around and be, call it even for a flat from last year. So there are a few states that are flat or below statewide. And of course, in Texas, there are some markets that are below pricing from last year. In Florida, there are a lot of markets that prices are down year over year, and there are some markets where it's up. So I could imagine a scenario where these compress even more and more of these states go negative, especially if we are in a world of where rates don't ease down and they stay elevated, and they've stayed elevated longer than anybody expected already into the first quarter. And so, we knew 7% mortgage rates were a possibility for this year. And it just seems like, we haven't had a reprieve of that at all yet. And of course, we're rolling into the spring, which is the biggest transaction time. So we will see if we get any reprieve and if this trend changes. But as of right now, you can really see the upper Midwest is where the price strength is. Virginia, we mentioned that we're going to look at the DC market later. Virginia is 6% home price appreciation year over year. And some of the Sunbelt markets are really where the pricing is the weakest right now. Okay. When I talk about home price changes, there are 5 different metrics of home price changes that we can track. We talk a lot at Altos about the active market, and there's a ton of signal in the active market. These are all the homes for sale in the country. There's 638,000 of those right now, and those are priced at exactly the same point as they were last year, 425,000. If you walk into the housing market around the US right now, that's what homes cost. It's a 0% change. At the end of last year, there was a 1% increase, so a slight increase. So the active market of all the ask prices is a little bit softer now in the first quarter. And the new listing side, uh, currently 410,000. So the homes that got listed this week are 410,000. That's up a little bit, 2.5% over last year. At the end of the year, it was a 4% gain. So new listings are compressing a bit. When we look at the pendings, so these are the 304,000 single family homes that are in contract right now. Those are priced currently at just under $400,000, 397,500, and that's up just over 2% from a year ago. At the end of the year, it was 4% from a year ago. So the theme here is that all of those price appreciation numbers are compressing. So we finished 2024 with about a 4% home price gain over the year prior, over 23. And now we're looking at about a 2% price gain over the year prior. If we look at price per square foot, so it's only 1.5%. So you can see it's a 0 to 2.5% gain in the range of home price changes for year to year. So that's really when I ask the question, could home prices go negative? Like, do these compress even further? Do these flip over negative? I think it's a possibility, especially if we were to get, tough inflation news that drives rates higher again, and mortgage rates follow after that. We could indeed see more pressure on home buyers, fewer transactions, and then more discounts in the sales prices. So that's what we're keeping our eye on in home prices. When we look at the leading indicators for home prices, we have the percentage of homes on the market with price reductions. And so these are homes that are on the market now. They don't get an offer in February. They do a price cut in March. They get an offer in April, and it closes in May. But we can see right now which of those homes are under pressure for pricing. And what we can see is that as of right now, 33% of the homes on the market have taken a price cut from the original list price. Now, any market has price reductions because sometimes it's strategic. Sometimes it's intentional to have overprice a house and then do one price cut before you sell. But if you're talking to potential sellers right now, I think the right message is that, while that's a strategy, you could overprice a house and do a price cut later to get to a transaction price. Because price cuts are elevated around the country right now, it would seem to me wise to do the other strategy, which is price it to sell now, because you don't want to be behind this curve with other people taking price cuts around you. You want to be ahead of this curve. So if you're in a situation where you're talking with potential sellers right now, showing that we have more price cuts in over a decade in February is a very, I think, powerful communication to give right now. It's price cuts ticked up in February, earlier in the year than we'd expect. It's not skyrocketing like it was back here in 22. So in 22, we knew that each week, tons of people were saying, "Wow, I got to get out before this is all gone." And so in 22 here, you could see the price curve or the price reductions curve just skyrocketing all the way through the year. So if you were listing a house here in April of 22, it was absolutely the message to say you want to be in front of this curve, not behind it. On the other hand, one of these lines like in here is 2020. Now in April, price reductions are falling. We could see that and they're low. We could see that homes demand was high, and now you have an opportunity to do a test the price. If you want to do an overprice strategy to test what people are going to get, now you have in 21, that's when that strategy works well. So if you're working with sellers right now, I think they need to be aware that price reductions are high. They're high early in the year. It's not catastrophic, right? We're not at 43% like we were in November of 22, but it's higher. And if it ticks up here, we could be at that level later in the year. So you want to be ahead of this curve, not behind it. And this is really a function of mortgage rates coming into January, climbing into the sevens rather than falling. In 23, price reductions started high. We were coming off this crazy fourth quarter of 22. But each week in 23, the price reductions were improving every week pretty quickly. And that was a signal of surprising buyer demand. So in 23, the headlines in the first and second quarter of 23 were home prices are down. Home prices are down year over year. Home prices are falling. But we could see in the leading indicator data here that it was improving each week. And so there was demand happening each week. And that really told us that there was a floor on the 22's price reductions. And so that was really useful in 23. But now we're in a different market. It's not nearly as bullish as 23. There isn't that surprising demand. In fact, it's pretty obvious that potential buyer demand is waiting for the right deal. They're waiting for the right time. They're waiting for moves in mortgage rates. And so you can see that in the price reductions data. So there's the most price cuts now in over a decade. Before I dive in, let's do one last thing on where we have the view of our forecast of home prices for the year, and then we'll dive into the local markets. We are forecasting a 3.5% home price gain. So this is the change in home prices. So here's that period of 23, that first quarter of 23 that was negative because home prices we saw earlier where they dropped in 22 so that the year over year changes showed up here in 23. And you could see all the way through 22 and 23, this is home prices softening the whole time. Through last year, home prices were in the 4s and 5s, appreciation nationally, 4 to 5% nationally. And then in December, mortgage rates spiked, and we can see that price appreciation was gone from the 5-6% range down to the 2% range now. So for Housing Wire, we are still forecasting a 3.5% home price gain for the year. So that means that we'll have some sideways if mortgage rates don't respond. If they get worse from here, we will have to drop this forecast down. And we could see that's the question I'm asking is, do home prices shift negative before the end of the year? I think it's a pretty notable slide in price appreciation. This Pulsenomics is a survey group of 100 housing market economists and forecasters. The folks who have the high forecast here are folks who are assuming that mortgage rates drop faster. And if they drop fast, then demand responds. The folks that have the low expectations for the year, these are the folks that are focused on affordability. And if they assume that affordability has to improve before demand improves, and if affordability hasn't improved and mortgage rates haven't improved, then some of those are coming out there. And so the scenario that they're focused on is an affordability one. So if rates stay higher for longer, you could imagine that that we have to drop ours. The long-term average, it's quite common for home prices to increase by about 5% per year over the long term in the US. So forecasting 3.5% is a weak year, is a down year, but not negative. That's what we're looking at forecasting. Before I dive into the local markets, I wanted to share in the Altos system. If you are new to Altos and you go log in, I want to show, or if you're an existing Altos customer and you haven't logged into your account lately, I want to encourage you to go log in and see our new reports layout. We're bringing the data to you more quickly, so you can shift over here to the list, to the market view, and see at a glance all of the markets you follow. And you can dive in and do a quick view of, here's the 8 key market stats. So you can go get that now in your Altos account. And if you're not an Altos customer, and you can go sign up for a free report and get in your first zip code and start diving in today. So that's a new release, and I just wanted to share it with everybody before we dive into the local markets. Okay, go to altosresearch.com and then you can go sign up for your latest. All right, let's look at some local markets real quick here. I have, let's see, here we go. So I have the Altos Advanced Analytics page up, and I have set up some queries to rank the prices. We were just talking about price cuts. So let's start with the price cuts. So Punta Gorda, Florida, so Southwest Florida, Sarasota, Tampa, this is all Western Florida with the most price cuts in the country right now. That's starting to climb already. Now, it's not dramatically higher. So a year ago, some of these were at 60% price cuts, but we're at 50% right now. You can see Phoenix is the first non-Florida market in the top 10. One other thing I think that's interesting in looking at this view of all the local markets is that in 2022, at the end of 22, there were a lot of markets around the country that had 60%. And right now we're in the 40s. So you can see a significant difference. There are a lot fewer markets that are in the 20s now. And so like more commonly, things are slowing down more evenly across the country right now is a takeaway on price cuts. In other words, buyers everywhere feel the pinch. There still are the tight inventory markets like Boston and Buffalo, and I'll show you Buffalo in a second, that have price appreciation, but they are, even those markets are feeling the pinch on the buy side. I have a few others here. I'm going to scroll down. I have a few others. So I mentioned DC, and we'll dive into the DC report in a second. But here's price reductions in DC. And we have 2025. There are currently 27% of the homes on the market in DC have had a price cut. It's not climbing. It's not spiking. It is a little higher than it was in the last couple of years, but it's not dramatically high. So on the question of, is the DC market tanking, price reductions are a really great way to see it. And we can see sellers. So the new listings in DC is actually fewer new listings now than in any of the last few years. So, you know, the reports that the housing market is crashing in DC is literally not anywhere in the data. And as I was saying, it could be that the current administration cuts a bunch of jobs, tanks the economy in DC, and we could see it in the future in the housing data in the DC metro. We do not see any weakness, any abnormal weakness in DC now. Now, contrast that to condos in San Francisco. And condos in San Francisco still haven't found the bottom from the pre-pandemic peak. And so I'm looking at price per square foot here. And so you can see price per square foot now it's still $950, but it's the lowest price in a decade for condos in San Francisco. So and that's in the city of San Francisco. It's not the metro. It is in city, and that's the hardest hit in terms of like tech workers not going into the office anymore, not needing a condo near the downtown. So I think that's a very different view than, say, what's happening in DC. I have a few others up here. Here's Dallas. Here's the unsold inventory in Dallas. As I mentioned, that last year, the 23 is the green, the 24 is the green line. Last year, Dallas had like 60% more homes than the year prior. And because inventory was rising so rapidly last year, Texas led the inventory gains. But the 2025 line now is flatter. And so it will continue. We'll have more inventory growth this year, but not as dramatic as in last year's gains. So those are a couple queries that I have up to keep my eye on how the market. So let's dive into some of the full reports. So this is DC. As I mentioned, DC is still pretty much a seller's market, tight inventory. If we look at 5 years of inventory in DC, we could see that there's 3,400 homes for sale. Just before the pandemic, there was 5,700. So there's still undersupplied in DC. If we look at price reductions, properties with price decreases, we can see that there is slightly elevated. Now, let's take this off, and just during the pandemic, very low. So this is a normal range for price reductions in DC. We can also see, though, that in DC, homes that are selling at the high end of the range, over $2 million, have much longer time on market, and the under 700,000 or so is moving relatively quickly, but not super fast. So you can see that there is moderate demand, very little inventory in DC, and no sign at all of like some flood of inventory coming, like literally none. It might happen in the future, but it's not in the data now. All right, let's look at Buffalo. I'm including Buffalo because we've talked about Buffalo as been maybe the hottest market in the country. I was talking on our podcast with Orphy Devingue from Zillow, economist from Zillow, and they talked about why Buffalo is the tightest market in the country there. And we can look at, you could see price appreciation last year in Buffalo, and we're a little bit above last year at this time. Home prices are a little higher than last year at this time. And so that continues the trend. If I look at inventory levels in Buffalo, we're still at or below the pandemic lows of homes for sale. There's very few homes for sale in Buffalo. And now here's an interesting thing we can see on the demand side. So at the high end of Buffalo, takes a little bit longer, but anything in the middle of the market, 300, 400, 200, those things are moving in like a month, very quick. The low end, this is not uncommon for a lot of like the upper Midwest, the Rust Belt, is these at the low end, there's $100,000 homes. These are tiny little 3-1s on a 4,000 square foot lot. They're 100 years old, and those take longer to sell. Those are not nearly as nice. So you get a little bit more house with a little bit more dollar, and you can see exactly where the demand is in Buffalo. As I mentioned in the past, why is Buffalo the hottest? Well, for years and years, we've been selling in Buffalo and buying in Florida. We've been moving from the north to the south. Because it is now more expensive to move and it's more expensive to buy in the south, we're selling fewer homes in the north, places like Buffalo. We're moving less often. Inventory is building in the south and it's tight in the north. So now if you graduate from college or you get married in Buffalo and it's time to buy a house, there's a lot fewer for sale because those people aren't moving to Florida. And And so the demand is relatively tighter in Buffalo. And so we can see the market action index is 50. It's a strong seller's market in that space because inventory is super tight. And if you price it right, the houses are moving in Buffalo for the right property. Um, let's look at LA because LA has been on everyone's mind with the fires. So in general, in Los Angeles, we can see that inventory is higher than last year at this time, 6,000 to 8,000, so 30% more homes for sale than last year at this time. That is growing. That's not really a result of the fires. That's really a result of higher mortgage rates. We can see that the price reductions are in line with the last few years. In 22, when the market cooled way off, we had this spike in price reductions. This was, we showed that nationally, very common. Uh, but LA is back into its normal range in price reductions. And you can see in LA, anything under $1 million or $1.2 million is moving pretty quickly. You know, the 5 million and higher is significantly longer to sell. I've been watching San Antonio this year. I'm interested in watching in San Antonio. And you might think about watching San Antonio in the same way we want to watch Washington, D.C., which is if the new administration's policies cause a bunch of people to lose their jobs in DC, that might drive inventory higher. If the new administration's policies deport a bunch of people from San Antonio, that might drive inventory higher as well. So inventory is already up about 20, 30% from last year in San Antonio. You could see basically a balanced market, a much cooler market than at 32 than Buffalo, for example. You can see that so the market in San Antonio is already much softer. And if San Antonio gets more inventory this year, then that could impact prices. And let's look at prices real quick. So you could see prices in San Antonio are down year over year. They're down for 2 years in a row. And so you could imagine that new administration policies that adds more inventory to San Antonio could impact San Antonio much more quickly than maybe the DC market is impacted. We can already see that at basically any price point is a much longer time on market in San Antonio. So that's a lot to, that's one of the reasons that San Antonio is one of the ones that I'm watching for the year. Let's wrap it up here and just, I can't get to all the markets in the US each month, but we cover all the markets. So if I didn't get to your market, go to altosresearch.com, grab a free report for your zip code and start diving in. I showed you how we have the new Altos, the new UI where we get you to the data faster. We get you at a glance to all the markets you're covering. And if you are working with potential buyers and sellers right now, they need to know what's going on. They need to know, am I going to overprice this or underprice? What's my listing strategy based on the price reductions in the neighborhood? If I'm thinking of selling in San Antonio, do I want to get out now? Or do I want to wait until later in the year when potentially more homes are on the market? Those are real questions that your buyers and sellers are asking themselves now. And that's what you answer with the data. It's not just vibes, it's dive into the data. All right, everybody, that's all the time we have for today. I will stick around in the chat to make sure we've answered all the questions. There should be links to Altos to dive in. If you're not already an Altos subscriber, go get the free account now. I highly recommend it. Get into the data so that we can talk more directly on the data right now. And we'll be back next month. I appreciate you all.